So I'm Catherine Taylor. I'm part of Affinitive. I'm really glad to be doing this panel today because it's very, very relevant to us, given that we're now a startup, one of the global largest startups out there. So thank you very much, my panel, for joining me today. We shall be doing the disruption and innovation of technology in financial services industry as a discussion point. Panel, welcome. Lim, would you like to introduce yourself?
Yes, so I'm Lim from running a technology group that comprises of two companies. One's ITF, abbreviation for Into the Future. We're envisioned to build a fintech bank as well as provide banking as a service. And Vision, which we are a blockchain as a service company. Collectively, we cater to the e-commerce, the finance, as well as e-government industry for blockchain, AI, and fintech.
Well, let's get to the juicy part of the panel, shall we? So probably quite a simple and easy question, but something that probably we should go back to basics. What is your view on what financial technology or fintech is? It's obviously evolved over time, but what is it today, right at this moment in time? And I'll start with you, Lim.
So I think that what we call fintech, right? Finance and technology add up together. I guess that in this particular space or in any other industry, there's always evolution of being able to look at how we can make something more efficient, be able to save time, make it more easier, be able to make things more clearer as well. So I guess that very much in the last number of years in the fintech space, we had a huge crisis in 2008, 2009, and a lot of areas has been focused a lot on compliance and ensuring that basically it's a lot of resources has been put into compliance of the likes. And I guess over that number of years from 2008, 2009 till now, we've seen that there's a lot of technology changes in the consumer space, whether it's from Uber, Airbnb, and of the likes. But in the financial space, because so much resources has been going into compliance of the likes, there's a very huge gap in terms of what we are facing today as whether it's a traditional bank towards what could be a more digital bank or more of a fintech bank. So to my personal opinion, I think the fintech industry, whether it's yesterday or today or even tomorrow, it's just about trying to make life a little bit easier, faster, more convenient for very much the users. And I guess if we can achieve that, then basically we have achieved our objective. That's my personal view.
The consumer should be driving it because we should be obsessed by consumers, not obsessed by technology.
Agree. I guess one of the things also is that very many a time when we go into events or conference or we see people pitching, one of the things is that we see a lot of consumer-based so-called startups within that specific area. I guess the ones that actually are people on the back end that's looking at certain efficiencies will be pitching to a different group of people. They might be talking specifically to the banks, they might be speaking to the regulators. So I guess the amount of people that we see on the front end coming out and doing their marketing versus the back end, usually it's a lot more on the front end rather than back end. The second thing I guess is there are a lot of people in the startup space that's coming out to do their so-called business within the fintech area. I guess many a time they are more familiar with the consumer end rather than the back end where that's a lot more domain and expertise that's actually required. I guess that's one of the reasons why we see a more prevalent amount of people on the front end versus the back end as well.
So one back end thing that we can't get away from is regulation, and you touched on it at the beginning. So whether it be anti-money laundering, screening for sanctions, RG97, MiFID II, the list goes on. I think you make money just naming them now. So do you think it's a bit of a challenge for the fintechs or the startups out there to keep up with those regulations and the obligations around that and those compliance processes?
Okay. So I guess there's two parts to this, right? So one part I would say it's, I think regulations has been changing over the number of years. There's quite a number of regulatory changes. I guess the regulators really see that as a huge problem. Two parts that they normally do. One area, I mean, there's quite a number of trends that's been happening around the region. I think in Europe, there's PSD2 that actually came out that get the banks to actually open up their APIs to other financial institutions. In Australia, there's the recent introduction of the third level, a restricted ADI license or restricted authorized deposit institute, where they allow so-called smaller companies with lesser paid-up capital to actually start doing some restricted form of deposit taking. In the areas of Hong Kong, they've came out with virtual banking license since the year 2000, but 2 years ago, they started really looking at that very much again. And in fact, there's 80 over companies that apply that since August last year, and most probably a couple of them might be approved this year. And many other jurisdictions around that. So the regulators do see that there's a need very much to incorporate in, right, very much newer regulations, specifically in the digitization of the fintech space. And many of them has also done two very important things. The first one is the regulators say, I might not know everything that's going on, but we cannot hamper the innovation of this fintech company. So what do? We create a sandbox where we allow different innovative companies to actually apply for it. And if there's going to be any damage done, it's within a small, restricted area. So I guess that's what some of the regulators have already done. Firstly, they have changed and incorporated in new regulations. And the second part, introducing a sandbox model. And on the opposite end of things, very much in other areas where regulations sometimes are very slow to pick up. I guess there are the companies like Uber and Airbnb, when they just go into the market, there's no specific regulation. They get it out and running first, and eventually start talking to regulators as well on how to basically get that.
Well, I think Facebook, for example, I think when they started out, they weren't even looking at regulations probably, but they're now over 50 licenses they're having to apply to, and that's just going to be, every social media firm is going to be the same. So that's a great segue into my next question, and it's almost linked as well. We all know the Royal Commission has created a bit of a trust damage for the big five banks out there right now. Does this give an opportunity for the neobanks and the fintechs in other spaces to really delve into that space? And I'll pose that initially to Lim, and then we'll go that direction.
I'll try to share because I might not be that familiar with it. But I think the thing about regulation is this, right? And the thing about very, very large companies, there's never a 100% perfect case scenario and the likes. And what regulators try to do is very much to minimize the amount of fraud, minimize the amount of damage that the masses can actually achieve. And the regulators do their best very much to do that. And I guess in any form of evolving, whether it's from country or industry or technology and all of the likes, that's always going to happen. Wherever there's some form of change, there'll always be some form of regulatory around that to try to protect or try to basically get it more regulated as well. Mm-hmm. What I always think is that at any point of time, the regulators will always change their regulations to suit the specific environment of which is being, and of course with the recent news and things coming out, I guess anything that basically helps the masses, that basically puts some forms of regulation around it, not extensively, but some forms of protection around it, it's always good for the masses. Not in stifling innovation, but for the masses. So I guess that's my specific point, that I guess when more and more of these regulations come out, it makes it a bit more clearer, the masses will help. For the neobanks and it's exactly the same thing. They eventually will have some forms of regulation around them to regulate it. But the question is, if it's going to be too much, then basically, not only on the capital raise part, they're going to literally have too many forms of documentation that they need to fill, then that's going to be a huge issue as well. So I guess the reason why a lot of the regulators around the world now are catering towards more specifically, like virtual banks or digital initiatives, is because they do see a huge change in the environment. Mm. And as long as we can see that there's a constant change towards the actual use cases of whatever's at that point of time, whatever's relevant, whatever's suitable, then I guess that's what the regulators are doing to make it a little bit more useful for, I guess, the people.
No, they're very true. So we're on to our last question. Before we finish up, please prepare any questions you may have in the audience. And this one I like, because it's a juicy one, and may make me money and I can retire in 5 years. And so the question is, who is the next Uber or WeChat, and what changes the behaviour of the financial sector? And feel free to say Refinitiv, we are Fintech now.
Definitely Refinitiv. Sorry, I'm not going to, I'll jump in. I'm not going to make you any money. I don't think we've seen the Uber yet. And I think for the reason that I mentioned earlier, Uber is the ultimate platform because you really have unlimited supply and demand. Well, you're limited to 7 or 8 billion, however many people there are on the planet, right? And they do balance the supply and demand with the amount of drivers based on population, and there's a lot of smart thinking going into all of that. But I think, you know, as I said, you get in the Uber, you get out, you pay your fee, and you're done. Financial services is very different. You know, there's a lot more to it, so I don't think there's going to be that one Uber in financial services that does that. But very keen to hear the panelists.
So I suppose my question to the other two then would be, what is the gap or the efficiency that needs to be given to create that next Uber?
So I think that if we look at the trends of what we call like the multi-billion-dollar companies and the unicorns of the likes, we take it like 30 years back and we looked at the companies of that specific type, and then we go into like the Microsofts and eventually the Googles, and then the Facebooks and the WeChats, and of course the Ubers and the Airbnb. And you see that a very specific pattern across those companies that actually go from where they were at startup and eventually grow into very big companies has a specific trend that somewhat similar, and very much certain things that are very much different as well. So you say that if you're going to pick a specific company that's going to grow really, really big, and looking at the trends of the history of these companies that's grown and become really big, what are some of them, and what are some of them that's slightly different in today's context and environment? And in my personal view, one of the key things today that is very different from previously is that the entire internet is more prevalent. Everyone basically has a mobile phone. Now, the changes in the user experience and how they interface with any forms of product today is very different as well. And what I feel moving forward that will have very good opportunity to eventually grow are companies that are very much hyper-localized, companies that are very much hyper-unique towards a specific niche itself. And when they get that niche really, really strong, it's then when they start to build an ecosystem around that to eventually grow. So I think the things to really look out for, at least in my opinion, are companies that potentially are very strong in capturing very strong stickiness with the customer, not just in massive number of users, but huge amount of stickiness, and then eventually growing and building the ecosystem around that. And I think these are the companies moving forward that have a chance to eventually grow and become something a little bit bigger.
Well, thank you very much, panel. I shall open up to one question from the audience. I think we're running short on time. Okay, maybe I can do two. One at the front? Or?
I want to ask you, what do you see as barriers of entry for cryptocurrencies becoming mainstream, and what has to change for that to happen from a regulatory perspective?
Take that one.
Regulation, liquidity.
Yeah, and institutional involvement as well. You can't build that just off retail trading.
There needs to be backed by fiat currency.
Yeah,
so they become a fiat currency.
Yeah, there's core fundamental things that we've just mentioned that need to underpin.
So as long as there's regulation that can regulate that, and there's more liquidity within the space, I think naturally that will become something that people use a little bit more.
Well, the regulation would attract the institutional family offices, the bigger players in the industry. So I think.
But unless it's underpinned, then it's just an asset class, and it's going to continue to go backwards and forwards. For it to become mainstream, it has to be tethered to some point of value.
Underlying value, yeah. Otherwise, it just becomes, well, what do you believe it's worth? What do I believe it's worth? And that's really how it's going now.
So repeat the question. So for matching platforms, what's the review of the credit element that they're obliged to make?
I think we've seen this with peer-to-peer lending, that it has been, in many instances, forget that we're in the business of credit. And what does that mean? It means if I borrow $100 from you and I lend it to him, you still want your $100 back. And I think a lot of people have lost sight of this in peer-to-peer platform lending. Then credit is a big, big issue. And it's been fine in benign interest rate environments. When interest rates go up, I think we're going to see a lot of problems in that area.
Yeah, I think that obligation doesn't go away just because technology is there. And that is an area that should certainly be looked at. And buy now, pay later is a classic example. It's an area that I have an issue with.
I think that basically in that particular factor, definitely the guy that lends the money wants his money back, right? But one of the things is that I think the way they assess credit nowadays is slightly different from previously. There's more access to multiple data points, and there's a lot of AI and machine learning that we can actually pull as well. And if you really look into that space, it's actually quite interesting what kind of information you actually be able to pull out as well. But that's a huge topic for another day. So.
Well, thank you very much, panel. It was very insightful. I think we've definitely concluded that the consumers have a lot more say in what they want, and it's definitely technology that's driving the financial community rather than the financial legacy institutions now. So thank you very much, Anthony. Thank you, Andrea. Thank you, Liv.
Thank you, Catherine.
Thank you.
Thank you.
Thank you.